Welcome to Earnings Central. In this video, we'll break down Lyft's third quarter fiscal 2024 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. Let's get started. Starting with top-line revenue, the original estimate for Q3 was $1.44 billion. The company actually reported revenue of $1.52 billion, surpassing expectations by 5.56%. This quarterly revenue marked a 31.03% increase compared to the $1.16 billion reported in the same quarter last year. Moving to adjusted earnings per share, or EPS, the original estimate for Q3 was 19 cents. The company actually reported an EPS of 29 cents, exceeding expectations by 52.63%. This result reflects a 20.83% increase compared to the 24 cents reported in the same quarter last year. Now, let's dive into some additional performance metrics highlighted during the earnings call. In Q3 2024, Lyft's gross bookings exceeded $4.1 billion, representing a 16% increase year-over-year. This strong performance was driven by continued growth in both active riders and ride frequency. The company's active rider base grew 9% compared to the prior year, while the average number of rides taken by each active rider, or ride frequency, increased by 6%. Lyft also saw impressive margin expansion in the quarter, with revenue margin improving both year-over-year and sequentially. This was driven by increased efficiency in the deployment of rider incentives, which declined 17% on a per-ride basis compared to the prior year. As a result, Lyft's adjusted EBITDA margin reached 2.6% of gross bookings in Q3. Looking at the balance sheet and cash flow, Lyft generated $243 million in free cash flow during the quarter, bringing the trailing 12-month free cash flow to over $641 million. This strong cash generation provides the company with ample liquidity to fund operations and strategic investments. Now, let's shift focus to some of the key insights and takeaways from the earnings call. One of the standout highlights was the performance of Lyft's Price Lock feature, which allows commuters to lock in a fixed price for their rides. The company noted that Price Lock has driven increased rider frequency, with users taking on average for more rides per month after purchasing the pass. This speaks to the value that riders are finding in the predictability and reliability of the Lyft platform. Another important aspect discussed was the continued reduction in prime time, or surge pricing. Lyft has been actively working to decrease the variability in rider pricing, and in Q3, prime time was down more than 40% year-over-year and 20% quarter-over-quarter on a per-ride basis. This has not only improved the rider experience, but also driven increases in conversion and market share in regions where prime time has declined rapidly. Moving beyond the core rideshare business, Lyft highlighted the progress it is making in two key partnership areas. First, the company announced a partnership with DoorDash, which will allow DoorDash's millions of subscribers to link their accounts and benefit from Lyft services. This is a strategic move to cross-sell between the two platforms and expand Lyft's customer base. Secondly, Lyft revealed several new partnerships in the autonomous vehicle space, including agreements with Mobileye, Nexar, and May Mobility. These partnerships are aimed at positioning Lyft as the go-to platform for autonomous vehicle operators, providing access to Lyft's extensive rider network, fleet management capabilities, and marketplace expertise. The company also shared insights into its Lyft Media advertising platform, which continued to gain traction in Q3, with in-app ads growing nearly 3x year-over-year. Lyft is focused on improving the measurability and performance of its advertising offerings, which it sees as an important component of its long-term growth strategy. Turning to the driver side of the business, Lyft highlighted its ongoing efforts to enhance the driver experience and technology. The company has launched a range of new features and improvements, such as an earnings commitment that guarantees drivers will be compensated for any unexpected delays during a ride. These initiatives are aimed at attracting and retaining drivers, which is crucial for maintaining a healthy marketplace. Finally, Lyft reaffirmed its asset-light business model, noting that its FlexDrive subsidiary handles the acquisition, leasing, maintenance, and resale of vehicles. This allows the company to focus on its core strengths of demand generation, marketplace management, and fleet utilization, rather than directly owning and operating a fleet of vehicles. In summary, Lyft's Q3 2024 earnings report showcased the company's strong financial performance, driven by continued growth in active riders and ride frequency, as well as improvements in operational efficiency. The insights and takeaways from the call highlighted Lyft's focus on enhancing the rider and driver experience, expanding strategic partnerships, and positioning itself as a leader in evolving transportation ecosystem, including the emerging autonomous vehicle market. As Lyft looks ahead, it remains committed to its asset-light model and customer-centric approach to drive long-term, sustainable growth. That wraps up our recap of Lyft's third quarter fiscal 2024 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way from Earnings Central.